Hi, I'm Bill Blaine, strategist at Shard Capital. It feels really strange to have seen the S&P 500 hit record highs last week, right in the middle of the summer, a time when it's supposed to be nothing much happening. Yet, we've just seen the fastest and strongest rally in 87 years now result in a record high, even as whole sectors of the global economy remain completely shuttered. Commerce is hostage to future infection outbreaks. We've seen elections delayed in New Zealand, which maybe has implications for the US later this year. Corporates face unprecedented solvency issues. Unemployment is set to explode. Supply chains remain fractured. Consumption could plummet. Government deficits are expanding at record pace to finance bailouts, support companies, furloughs, and rescues. The outlook has never looked so dire, yet stock markets are completely risk on, despite the pandemic being the most sudden, profound, and destabilizing shock ever in economic history. And there is a threat of a deepening recession round the corner. It just seems a denial of common sense. How can markets thrive in a time of economic mayhem? Well, conventional wisdom, as I recently read in a US investment bank's equity strategy note, tries to explain the gains in terms of markets anticipate better days ahead. Although the timing is uncertain, the stock market is expressing confidence the pandemic will end with a vaccine and better treatments in the interim. That just sounds like absolute nonsense. Markets are supposed to be rational. A vaccine tomorrow is not going to undo the damage already done, and at best it's only going to accelerate recovery back to where we were. Corporate earnings might take years to recover, and betting big on the hope of a vaccine sounds a bit of an irrational toss of the dice. And hope is never a good investment strategy. To understand why markets are so strong, you really need to follow the implications and consequences of government, and particularly central bank action. Markets follow money, and that requires you to forget everything you ever thought you knew about stocks, bonds, prices, and future valuations. What is important is that central banks have promised to do whatever it takes to avoid meltdown. It no longer matters what investors think about the economy. If they're certain that central banks will bail them out, then that dictates their behavior. What matters most today, in today's hyperbolic markets, are the consequences of zero interest rate policies, or ZIRP as we call it, and QE infinity. ZIRP distorts the assessments of risk versus returns, and QE has flooded markets with liquidity ever since the pandemic started. It's staved off immediate recession, it's avoided corporate bankruptcies, and it's avoided a crash. That's success, but it comes at enormous cost. We all know that enormous economic damage has been done by the pandemics. We know that many corporates are closer to bankruptcy than ever, and we know that global supply and demand remains very stressed and is likely to get worse. Smart money is not investing on the basis of recovery. They're simply investing because they know that central banks have no option but to continue bailing themselves out. But not everyone is smart money. Most people are followers, and they're very easily persuaded of the merit of snake oil salesmen who promise enormous returns. That has been the history of markets since day one. If you can persuade people that stocks are going ever higher, then they'll buy. So most investors aren't particularly aware of what's going on in central banking just now, or what's going on under the surface. They just see a market going up, and they're hit by FOMO, the fear of missing out. It really is one of the most powerful forces in finance, and it's particularly relevant in funds management industry, where complacent investment managers are far more concerned about career risk rather than market risk. Missing a rally like the one we've seen since March would be a career-limiting mistake, and career risk explains why most investment managers do little more than benchmark themselves to indices. This rally has developed a momentum all of its own. It's sucking in buyers who fail to see the dangers implicit in the herd mentality that we've got at the moment. It is a real triumph of hope over common sense. Look at the Robin Hood retail day traders who are unencumbered by conventional wisdom. They genuinely believe the most dangerous 4 words in the market lexicon. This time it's different. It's never different. Take comments like that with a pinch of salt, because this is not over. There is much more pandemic grief and pain to come. Yet the central banks can't afford a sentiment crisis or a stock market crash to happen. They've no choice but to continue the illusion, keeping returns repressed and inflating financial asset values to unsustainable levels. Unsustainable means just that. There are no returns in the bond markets, but we can't allow markets to pop. Therefore, I'd pick a very simple investment strategy at present. It plays to the promise of central bank, whatever it takes, market support, but alongside that, you need to build a clear risk-off base. Basically, arbitrage central banks juicing the markets while preparing your bunker for the nuclear equivalent of nuclear winter, which means buying gold and bonds alongside stocks. In terms of recession, does anyone think a V-shape's possible? Of course not. There is data that says it might not be so bleak as we expect, but certainly jobs are being lost as fast as we've ever seen, and we're seeing stores and companies closing. It puts the world into a very difficult and gloomy economic concept. If it's not the retail high street, then it's China, where we have seen something of a recovery, but the Chinese economy is nowhere close to where we expected it to be at this time. They are suffering from the stickiness of recovery, and that's likely to be repeated everywhere else. Economies will not recover to their full potential if a large number of working women, say, are forced to remain at home because teachers refuse to go back to work because it's too dangerous, and if the trains won't carry full passenger loads. These things are going to impact us for a long, long time. It's clear that the concept of a sticky recovery is one that's going to become more and more common in economic discussion in the next few months as we try to explain why the V-shape hasn't happened and why we've got successive downturns. I reckon we'll get 95% of the way back very quickly, but the last 5% will be very difficult, and we're already seeing that in terms of redundant workers being permanently removed from the workforce, which is one of the reasons that we've started to see the unemployment numbers start to come down. Whatever happens, the next few weeks and months are going to be intensely interesting in terms of where the COVID pandemic continues to impact the market, but particularly in terms of where markets go. It's going to be fascinating, so let's keep a close eye on what happens next. Thank you all very much.